Okay, good morning, everyone. Thank you for joining our live webinar, Avoiding the Pitfalls of Business Ownership. Today, I thought it'd be just a good chance to run through some of the most common queries that we get when we're speaking to business owners. The logic being that if it's something that's relevant to most of the people we're speaking to, then hopefully it's going to be relevant to a lot of you out there as well. So we'll run through the agenda shortly, but just before we kick off, I'd just like to say that this is a recorded webinar, so we will be placing it on our website after or shortly after the webinar for anyone who wants to watch it at a later date. And also, as we're going through the webinar, there is a little Q&A section on your screen. So if you have got any questions, please feel free to put those down, and we're trying to cover those at the end of the webinar as well. So the main things we're going to run through today are, the first one is going to be, how do you pay yourself from your limited company, and what is the most tax efficient way of paying yourself from a limited company? So we'll be running through some of the thoughts that you need to be having in relation to that, and some of the factors that might impact on how you pay yourself. The second thing that we're going to be looking at is, should you have a company car or should you use your personal vehicle? And again, it's not a straightforward answer, and it would depend on a number of factors. So we'll just be talking through some of those. And the final thing that we often have queries on is the director's loan account. So what is a director's loan account? And also, what are some of the implications of having an in-credit loan account or an overdrawn director's loan account? So we'll just be running through some of the thoughts in relation to that as well. So I'm joined today with Shelley.clarke, who's a manager at Knights Low. She has got a portfolio of owner-managed businesses. So it's very relevant, this webinar, to her. There's sort of a lot of things that she's coming up or faced against on a day-to-day basis, if not on a week-to-week basis. And I'm Kirk, Vaughan. I'm a client services director at Knights Low. I've also got a lot of clients who are owner-managed businesses. So again, it's something that's really quite common, that we're dealing with on a regular basis. So the first point, what is the most tax efficient way to take profits from my business? So it says up there, dividend versus salary. So what are your thoughts, Shelley, when you get asked this from clients? What do you tend to what do you tend to tell them in relation to this?
It normally starts with it depends. So it really does depend on circumstances. So there's so many factors to bear in mind. But I think if we talk through first sort of the process of having a salary and having the dividends, and then we can sort of look at circumstances that we might adjust that and we might tailor it slightly differently. So in terms of taking a salary from a business, generally speaking, if you've got a company, what we'd recommend is having a small salary. And what we mean by that is taking a salary up to a certain threshold that is tax efficient. So currently for this tax year, we've got two different rates because things change come July. But based on the current rates that we're working with, there's various thresholds that we need to bear in mind. So the big ones are your national insurance thresholds. So if you are a company and you are eligible to claim the employer's allowance, which is the deduction of your first £4,000 of employer's national insurance, what we do is pay a salary up to that threshold, which is currently 9,568. So let's say 9,500 for ease. If you can't use that benefit, you can't claim that allowance, what we'd actually do is take you down to the secondary threshold, which is the 9,100. So that threshold, you're qualifying for state benefits, so you're qualifying for your state pension and everything along those lines, but you're not paying any national insurance. That all changes come 1st of July, and when we jump into the new tax rates, we're going to take you up to a prorated 12,570 salary, because that becomes the threshold where we're not going to be paying any national insurance. So yeah, when we talk a low salary, it is a low salary, but that will depend on circumstances. The main reason why we're doing that salary is, of course, we're going to get various reliefs through the company. So the first one is we're going to get corporation tax relief on a salary wholly and exclusively for the purpose of the trade. So Kirk, you probably see it where we have a number of clients who are perhaps husband-wife businesses, And they'll quite often say to us, well, my wife's doing, let's say she runs the company and husband's doing the bookkeeping. We'll then look at paying them probably the same sort of salary because it's more tax efficient to do so.
Absolutely. I mean, typically if you have got a husband and wife business, then if you've just got one spouse who's drawing all of the funds out of the business, it's not going to be the most tax efficient way of paying that family. But it is important to ensure that the second spouse who's potentially going to start taking a salary is actually playing an active role in running the business. So they might be a director, they might be doing some admin tasks, the bookkeeping, the invoicing, chasing debts, whatever it might be, but we need to be able to justify any salary that we pay to that other family member or spouse. So that is really quite important. But if we can justify that, then there are significant tax savings in doing that as well. Of course, there are also other benefits of paying a salary. The main one obviously being that you do get credits towards state pension or state benefits as well. So to qualify for state benefits, you need to be earning at least to that lower earnings threshold. So if you are paying yourself the salary of about 9,500, which is the sort of levels we were talking about a minute ago, then you will qualify for state benefits. So that would be a year's credit towards state pension, for example. There are also other formalities that need to be followed when processing payroll. So you do need to have a PAYE scheme with the revenue. You do need to be completing real-time submissions with the revenue as well. So it's just making sure that the correct processes are followed to make sure that that is a valid salary that's being paid.
Absolutely, it's well worth speaking to. So we've got a payroll team here that can help. There's various softwares as well. If you're using Xero or QuickBooks, they have a payroll function. But it is very important, that setup process, to get that right first time. Because we quite often see new clients coming to us and they're not claiming, for example, the employment allowance. So they're missing out there and they're actually paying over a significant amount of national insurance just because a setup hasn't been done right or hasn't been looked at initially. So it's really important to get that right and then follow that through month on month, or however frequently you're doing your payrolls, to make sure that you're meeting the compliance side with HMRC for PAYE.
Absolutely. I had a client the other day where they were doing their own payroll, didn't claim the employment allowance, and it was an additional £4,000 worth of PAYE that they'd effectively overpaid. So yeah, it's incredibly important to make sure that that allowance is being claimed.
Absolutely, and there's various rules in claiming that allowance. So what I would say there, if anyone's got any concerns or any questions on it, just reach out to us, because we can take you through, we can look at your business and take you through whether you are able to claim it or not. We won't sort of delve into the details on here. But obviously once we've paid you that small salary, what we then want to do is look at, okay, let's top you up some dividends. So dividends they arise from your retained profits. So your profits after tax that you've accumulated within your company. So that's after you've paid your corporation tax and all of your business expenses have come off there. Those dividends are paid on your shareholdings. So they're nothing to do with the role that you have in the company. If you're a director, if you're an employee, it is purely based on your shareholding, which is, again, a really important part when you're setting up a new company, is making sure we get that share structure set up correctly to be as tax efficient as we can here. Dividends have a lot more flexibility in terms of how much we're going to vote, how frequently we want to vote them. And you'll see you can have peaks and troughs and sort of mould it depending on what someone's remuneration requirements are. It's really important with dividends to get the paperwork in place, though. HMRC will look at the source date of paperwork. So not just the date that the dividend voucher has, they can delve deeper and actually look at what date was that document prepared, because they want to know that that dividend was declared on the date that you said, because you can't manipulate them to fall in a certain tax year. So really important there to make sure that paperwork is spot on before you go ahead with that.
Absolutely. So when we're looking at the tax of dividends, the rates of dividends are actually lower than the rates for salary. So salary rates are 20% for the basic rate, whereas the basic rate for dividends is 8.75%. Now, you may sort of initially think, well, why don't I pay myself dividends instead of salary, because it's taxed at a lower rate? So, we're saying at the minute that you should pay yourself a low salary. the reason is salary is deductible against your corporation tax. So when you pay yourself a salary, that will reduce your corporation tax. But dividends, when you pay dividends, you've already had corporation tax paid on those profits. So you're not getting the same tax relief in the company. So we need to weigh up all the taxes when we're working out what is the most tax efficient way of drawing funds from the business. So like I said, the basic rate of tax of dividends is 8.75%. The higher rate of dividends is 33.75%. With dividends, you also get the first £2,000 worth of dividends, which is tax-free. So that's for every individual, and that is irrespective of what your income level is. So for some businesses with relatively low profits, you might be saying, well, pay yourself a salary of £9,500 plus £2,000 dividends, because as long as the profits are in the business to draw that dividend from, and that is very important, we need to make sure that there are profits to draw dividends from, otherwise they are illegal dividends, then it makes sense to draw that dividend, even if the company doesn't have the cash to pay it. What we can do is we can vote the dividend so that it's taxable on the individual, although it will be covered by the dividend allowance, and then leave the funds within the company so that it can be physically paid at a later date. So when it comes to paying yourself, it's not necessarily about what can the business afford to pay you. It's almost more important to look at, or equally as important to look at, what profits are available in the business to pay dividends from.
Yeah,
so,
absolutely. It's well worth using that 0% band, especially when we've got multiple shareholders. It's something we really need to look at to utilise that as much as we can using that £2,000.
Yeah, absolutely. And then just finally, the additional rate of dividends. So if your income's over £150,000, it jumps up to 39.35% as well. So that's the general mix of remuneration that we would see for the majority of our clients and the majority of small business owners. So low salary topped up with dividends, and the level of your income is also has an impact on how tax efficient your drawings are from the business. So for example, there's different bands where you pay tax rates, different tax rates. So the first £50,270 is the basic rate band. So sometimes that's a good level to have your total remuneration up to, so that you're utilizing your basic rate band and you're not paying any higher rate tax. So that's very often a good place to be. You've also got the £100,000 threshold. So once your income increases above £100,000, then you start to lose your tax-free personal allowance. And what that actually means is when your income is between £100,000 to about £125,000, your effective rate of tax is 60% and not 40%. So again, that's a bad place to be between £100,000 and £125,000. So very often we will see clients trying to get their income just up to that £100,000 threshold. So they're using all of that £100,000 threshold, but not paying the higher rates of tax if they go beyond that as well. You've also got the £150,000 limit, which is where you start to pay additional rates of tax. So again, sometimes clients will try to get just underneath that to avoid paying an even higher rate of tax. And there's also a band between £50,000 and £60,000, which is the point that you start to have to repay child benefit payments. So for those who are receiving child benefits, if your total income is below £50,000, then there is no need to repay child benefits. And that's on an individual basis, not on a combined husband and wife basis, for example. But once your income exceeds £50,000, you start to have to repay your child benefits until your total income exceeds or reaches £60,000. So it's kind of on a sliding scale that if your income, for example, is £55,000, you would have to repay half of the child benefit amounts you receive.
Yeah, we see that quite often with a growing business, don't we, where you're claiming those child benefits and then one of the partners will creep over 50, and then we have to obviously bear that in mind when we're looking at total remuneration planning. Are we going to push them way over, and therefore it's all going to be repayable and they stop claiming? There's lots of factors to bear in mind there. We also have to consider, as part of this, is do you have any other income sources? So, for example, does the company use a property that you own? So does the company pay you rent? Because that can be a really tax efficient way of receiving income from the company. But again, that property has to be in your name for them to pay you the rent. Other options we do have is, obviously, we can look at any tax benefits. So we can look at, do you have a company car? Do you have private medical insurance? Are you claiming, so do you use a personal car? So are you claiming all your business miles? So you can obviously claim those at 45p per mile for the first 10,000, and then it drops out to 25p thereafter. There's also trivial benefits that can be used. Trivial benefits are a nice little system brought in a couple of years ago by HMRC to try and mitigate some of the reporting we were having to do on these small benefits that were being paid to employees. But in brief summary, for directors, you can have a trivial benefit of up to £50, not a penny over, up to 6 times a year. Can't be cash or a cash equivalent. The most common one we see, Kirk, is vouchers, isn't it? We see most people buying gift vouchers, Amazon vouchers, but that's a really easy way of getting £300 out of the company each tax year, tax-free. So that all has to be factored into sort of the total remuneration planning. And another big benefit, obviously, that we see is pensions. So the company paying into your pension scheme. There's various rules on how much you can put into your pension scheme, but by and large, your company will get corporation tax relief on the pension contributions that take you up to a fair remuneration, so a market rate remuneration for someone doing your role.
Absolutely. And I mean, that's quite a quick overview, really, of some of the sort of factors that we're thinking about when setting up remuneration for our clients. It's not a one size fits all. There are some general principles that I think applies to most clients, but it will depend on every client's or every business owner's circumstances. There might be other income sources they've got. They might have pension income, they might have rental income, investment income. So, that there are a lot of things to take into account, but hopefully that gives you an idea of some of the main principles when it's come to drawing funds out of that business. So the second question that we often get asked is, should the company pay for my car? And there's a running theme here, I think, but the answer to this one is also, it depends. It depends on a number of things, but I think before we sort of run through the main principles, I think it'd be quite useful just to run through how a company car is taxed and some of the tax implications of having a company car, because I think that will help to explain what kind of things will have an impact as to whether it's best to have a company car or not. So if the company provides an employee or a director with a company car, then there will be, and if there is personal use of that company car, which will include traveling from home to a place of work and then home again, so commuting, then there is a benefit in kind charge, an employment tax charge for the employee. The way that benefit in kind charge is calculated is by taking the list price of the car, which is effectively the brand new price of the car, not the market value of the car today, and you multiply that by a multiplier which is based on the CO2 emissions, i.e. how green the car is. Now, generally, the cleaner the car, so the more energy efficient, I suppose it is, the lower the CO2 emissions, the lower that multiplier will be. You've then also got a fuel benefit in kind as well, if the company provides any fuel for that car. So this is often an area where the revenue tend to have a field day. If they see that the company is paying fuel for a car, even if it's only 1 or 2 times throughout the year, they will look to apply a fuel benefit in kind, because the rules do state that if there is some fuel paid for by the company, then that will be treated as a benefit in kind, a fuel benefit in kind. So it's really important to make sure that the company either pays for all fuel, in which case there is a benefit in kind, or the company doesn't pay for any personal fuel. And the way that you can do that is, number one, the company doesn't pay for any fuel, or if the company does pay fuel, you have to make sure you keep very detailed mileage logs to calculate the level of personal miles done, so that you can then repay any personal petrol using the fuel scale charge rates as well. So it's really important to make sure understand how strictly the revenue apply those rules. Now, the fuel benefit in kind is using that same multiplier that we talked about when we had the car benefit in kind, and multiplying that by a standard £25,300. And that will give you a benefit amount, which is then subject to tax on the employee. And the company will also pay Class 1A national insurance on the value of that benefit, or those benefits as well.
Yeah, it's worth noting sort of with that fuel thing, it's a very expensive mistake to make. So it really is important to get that right. Like Kirk was saying, keep those details, make sure everything is spot on there, because it's a very expensive mistake to make if HMRC do come and have a look at that. Other factors to consider, so in terms of corporation tax, so if you are buying the vehicle rather than leasing it, there's various capital allowances to be factored in when you're looking at your corporation tax charges. So again, this is dependent on how green the car is, so looking at your CO2. So if the car is 50 grams or over per kilometre, you're going to be restricted down to only 6% capital allowance. So you don't get a huge amount of tax relief very quickly. It really takes a really long gradual process to eat into that. If you're looking at a much greener car, so if it's a fully electric car, you're looking at 100% first year allowances. So what that means, if you buy a car for £50,000, you're getting 100% of that deducted against your corporation tax profits. So much more beneficial when you're looking at the greener routes in terms of buying a car. When you're leasing a vehicle, the rules are very different there. So in terms of leasing a vehicle, if there is any personal use of that vehicle, you have a 15% deduction for a vehicle that's over 50 grams per kilometre of your lease charges. So you don't get full corporation tax relief on those lease charges. So it's just worth, when you're looking at vehicles, it's really weighing up the pros and cons of each in terms of your corporation tax reliefs. Of course, when you own the vehicle in the company, you do get your corporation tax deduction for all your running costs. So your MOT, your service, your road tax, insurance, all of that, you're going to get corporation tax relief on that. Whereas if the vehicle is personal, you're not going to get any tax relief there.
And sometimes that's an important point, because sometimes we find that clients like the fact that the company can cover all of those costs, and the tax is almost a secondary point. And it's very easy for us to focus on the tax and advise on what is the most tax efficient thing to do. And I think that is important, but it's the risk of it as well. You know, some clients like the fact that if there are repairs or maintenance on the cars, that's not something they have to personally provide for. That is something that the business covers, and it gives them that peace of mind. So that's another important factor, I think, when looking at whether to have a company car or not. The only other tax implication we're looking at is really VAT. So when we're looking at cars, if there's personal use on that car, and most of the time there will be personal use on a car, because again, commuting to and from work is treated as personal use, then there is a block on VAT when you buy cars. So there is no VAT that you can claim on the purchase of the car. Now, when you're leasing, the position is slightly different, because you're able to reclaim 50% of the VAT if the car is used mainly for business purposes. So if the main purpose of that car is business use, and there is some private use on it as well, then leasing will actually put you in a favourable position when it comes to VAT. Although you don't get so much quick tax relief quickly, because you get all your tax relief via capital allowances up front if you buy a tax efficient car, as we mentioned a little while ago. So it's kind of weighing up all the different tax benefits and positions to work out what the best thing to do is.
Absolutely, it's a classic. It depends from us as well, doesn't it? But it really does depend in this situation as to what car you are looking at. we're finding more and more people are asking us this question, obviously with the price of cars soaring, secondhand and new, we're finding a lot of people wanting to explore this avenue. And it really is, it used to be your gas guzzlers, so your diesels, your heavy petrols, they were really unappealing and still are really unappealing to have as a company car because of the rate of that multiplier that gets applied. They just become really unappealing to everybody, whereas the electric cars, and this is the pure electrics, are much more efficient. You also of course have your hybrids, but we've got a range there, depending on what their electric range is as to how they're taxed, how high their multiplier is. But yeah, electric car is much better. So for example, an electric car, you're looking at 0% no emissions, so you're looking at a multiplier of just 2%, whereas if we compare that to let's say a big gas guzzler, you're looking at up to 37%. So a really big difference there. And also another benefit with your electrics is if you charge it at work, there's no fuel charge, there's no fuel benefit there. Whereas obviously, like Kirk explained earlier, any sort of personal fuel going into that vehicle, you have to be so careful with, to make sure you're not getting hit by that multiplier. And again, if you're looking at that 25,300, that could be times by up to 37% to get your taxable benefit.
I think practically the problem we're seeing most clients have is actually getting hold of electric vehicle. I think there's quite a significant delay and backlog in getting electric cars at the minute due to a shortage of chips, apparently. But you know, that aside, it certainly makes sense to go with an electric vehicle if it suits your needs and it works on a day-to-day basis for what you need that car for. Just to try and put all of that into perspective a little bit, we've sort of got a couple of examples where if we had a client who spent £100,000 on a car, so we have one client who buys an electric vehicle, a pure electric vehicle, so they would have a 2% benefit in kind charge on the list price of £100,000. So they would be treated as though they've got additional earnings or salary of £2,000. Now, assuming they're paying tax at 40%, the higher rate, then the tax cost of them having that car would be £800 per year. So that's the personal tax cost incurred of having that car. There would also be Class 1 national insurance payable on that, and that would be charged at 15.05%. So 15.05% of that £2,000 would be about £300 worth of national insurance that the company would have to pay. If we compare that to a not very tax efficient vehicle, so we're talking about our gas guzzler here, which has got potentially a big engine, might be a diesel, typically sporty type cars. So if we had another £100,000 salary, or £100,000, sorry, vehicle, it's likely that the multiplier for that, the maximum multiplier can be 37%, which means that we've got a £37,000 benefit in kind, which is treated as additional earnings. Now, assuming that that is taxed at 40% like we did before, that's actually going to create a tax liability of £14,800 per year. So you can see there that two vehicles, very different from a tax point of view. The personal tax cost increases by £14,000 a year. So it's not just a one-off cost either, it's an annual cost this is for driving that not very tax efficient car through the business. So clearly you can see that depending on the type of car that you are wanting to drive will have a big impact on whether it's sensible to have that as a company car or not. I mean, if we actually take that on a little bit and say, well, if the company also provided electricity or diesel or petrol for that vehicle, then, you know, there'd also be a fuel benefit in kind to take into account. Like we said before, there is no fuel benefit in kind for electricity. So for the electric vehicle, there is zero benefit in kind and therefore no tax to pay. But for the tax inefficient car, the one with the petrol or diesel vehicle, the gas guzzler, then we've actually got a benefit in kind of another £9,361. Again, if that's taxed at 40%, then we've got just under £4,000, so £3,744 of additional tax to pay a year. So the difference in that example between the two cars is actually over £17,500 difference for personal tax costs. You've also then got the benefit in kind Class 1A national insurance that the company pays. And you've actually got a difference there of about £3,500 as well. So the company's got to pay an additional £3,500 national insurance for providing that gas guzzler as a company car compared to the electric vehicle. So clearly there's some really big differences there in terms of the tax costs of different cars.
Absolutely, and it's worth noting, so when you're looking at a hybrid, you're looking, depending on your electric range, you're looking at anywhere from 2 to 14%. So again, your hybrids, it's better than a gas guzzler, but 14% can soon add up when you factor in that list price stays the same. So you might think, I'm going to keep the car for 5 years. That list price doesn't depreciate. That list price stays as it is. So you'll keep feeling that tax impact every year on that higher price. So yeah, if you are looking at a vehicle or considering what route to go down with a vehicle, it is worth having the conversation, letting us know what ones you're looking at, and we can sort of run the numbers for you so you can make an educated decision knowing what your tax costs are going to be on there, because that all flows into your remuneration package.
Absolutely, it's definitely one that's worth checking beforehand. Like I say, once you've bought the vehicle, it becomes difficult to transfer it as well, especially if there's finance or if you've leased the vehicle. And then sometimes you can kind of be trapped, if you like, in that position for a few years. So it's definitely worth getting advice in advance in relation to that. So the final thing that we was going to run through, and again, this is another hot topic when it comes to speaking to clients or business owners, is what is a director's loan account and what are the tax implications of a director's loan account. So Shelley, do you want to just run through what a director's loan account is first and foremost?
Yeah, absolutely. So the biggest difference we see here is when you set up a company, you've got to remember that that company is a separate legal entity to you. So its finances are completely separate to yours. So your director's loan account is an area where we collect any money that you have loaned to the company. So anything you've invested. So let's say perhaps when you were starting up, you put £20,000 in to get the business going, or anything that you've taken out. So let's say, again, that 20,000, think, right, I'm going to start taking that out over the next couple of months. That's what we have to record and pull that all together. So it's a balance between what is owed between you and your company. And it's really important that we track this and we get it right, because there are some significant tax impacts of this loan account. It all flows into your remuneration planning. So like we were talking about earlier, you don't have to take, so if you didn't have a huge amount of profits, perhaps you're a startup business and we voted a £2,000 dividend, but you haven't got the cash to take that yet, that comes into your loan account. So you effectively are loaning that £2,000 to your company. And in due course, you'll be able to draw it down when the company has actually got the cash there. So yeah, it's really important to keep yourself and the business separate, because this can be a difficult area to keep track of. If we've got a lot of private transactions going through, it can be a bit of a headache, can't it?
Yeah, absolutely. And I think it's key as well to be reviewing your director's loan account on an annual basis. So what will typically happen is the accounts are prepared and there will be a director's loan account, which may have a few transactions going through it. It might have quite a lot of transactions going through it, but it's very important to be reviewing that to make sure that everything in the director's loan account is personal, because if it's not, if there are business expenses in there, then potentially there's no VAT being reclaimed, potentially there's no tax relief being reclaimed on those expenses as well. So it's just really key just to make sure that you're comfortable that everything passing through there is correct, and being aware what the position is. How much does the company owe you, or how much do you owe the company as well? So that's very
vital to track that, because the tax implications, pros and cons, can be quite significant. So if we use an example where, let's say we're a startup company and we've actually invested £20,000 into our startup, so we need to top up the bank account, we need to buy some equipment, perhaps we need to get a lease for a property. That loan of money that you've put in there, that company then owes you it back eventually, but it will be repaid as and when it can afford to pay you. What we can do there is we can actually have the company pay you interest on the loan. So again, another form of remuneration planning for us to use there is for the company to pay you some interest. There's various restrictions as to how much interest they can pay. So we're capped at a market rate interest. So if you were to go to the bank and say to them, I need to borrow £20,000, what would they offer you? What rate would they offer you? And that effectively helps us decide what that rate of interest is going to be. What happens there is the company effectively is being charged interest by yourself, so you're receiving some interest income personally, and the company, as long as it is holding exclusively for the purpose of trade, so we needed that money for the trade, it gets a corporation tax deduction for that. So let's say, for example, you charge £1,000 of interest, the company is going to get corporation tax relief at that £1,000 of interest, and you're going to have £1,000 of income coming in, which, depending on your tax levels, or your income levels rather, you might be able to utilise some of your savings allowance there, which means that depending on your levels, you're going to get some of that at 0% tax. There is an admin side to doing this though. We do have to file a return, so a CT61, for the payments of the interest that are made. So the company has to deduct 20% tax from those interest payments, so you receive a net payment from your company. And what that happens is it pays it over effectively on your behalf. And then we come to do your tax return, we make sure we include it in there so you don't suffer any unnecessary tax.
Absolutely. So again, following on from the first question that we discussed today, it can actually make up part of tax efficient remuneration that you draw from the company as well, if you do lend money to the company. But what I'll go on to now is to sort of consider some of the tax implications if you borrow too much money from the company, so you have an overdrawn director's loan account. Well, there's a number of issues here. So, I mean, the first implication I would say is that it's bad practice, and it is something that has to be disclosed in the year-end accounts that you file as well, to show that you have borrowed money from the business. So some clients don't like that because it is sensitive information and it might be looked badly upon by suppliers or customers or the bank. So it's just being aware that if you do borrow money from the company, then that is visible if the balance is outstanding at the end of your financial year. In terms of the tax implications, if the loan balance is more than £10,000, then it will, and if no market rate of interest is charged on that loan. So this is the other way around to what Shelley was just talking about a minute ago. So this is where the company is charging you interest for borrowing money from the company. So if that interest charge is below 2%, so that could be 0, for example, then you will have a benefit in kind, which is subject to income tax, and the company will also pay Class 1A national insurance at 15.05% as well. So it's just worth bearing in mind that if you're borrowing money from the company, then there is a tax charge there if the company doesn't pay you interest, if you don't pay the company interest. So, I mean, very often we will see that clients will pay interest if their loan does go overdrawn, because there's actually a simpler method of tidying up the loan account. I think most clients tend to find that's the best way to deal with things. So that's one tax implication of the director's loan account being overdrawn. A second tax implication is what we refer to as a Section 455 tax charge. And what this basically means is that if your director's loan account is overdrawn at the end of the year, and you are a participator in the company, which means that you own more than 5% of the company, or close family members own more than 5% of the company, then the company has to pay tax on account at 32.5% of whatever that overdrawn balance is if that loan is not repaid within 9 months of the end of the year. So, for example, if you borrow £10,000 from the company and that balance was owed to the company at your year end, which is the 31st of December, if that loan was not repaid within 9 months, so the end of September, then the company has to pay £3,250 to the revenue on account, and the company can receive that money back from the revenue once that loan has been permanently cleared. But so it's only a cash on account, it's only a timing issue, but the timing of when you get that money back means you have to wait another 9 months after the year that loan has been repaid to receive that money back. So it can be quite some time when you work through the dates when you can actually recover that tax back. And the purpose of this tax really is the revenue saying, well, if you've borrowed money from the company, had you have paid dividends to fund that money, then you would personally be paying tax at 32.5% if you was a higher rate taxpayer. Now, if you haven't paid or voted dividends, but you've just borrowed the money from the company, then in effect, the company's paying that 32.5% income tax cost on your behalf until you do vote that dividend. So it's just trying to put the company or the revenue in the same position from a tax generation point of view as if you had taken that money out as a dividend. So that's a very quick overview of that tax. It's a little bit more complicated than what I've tried to explain it, but I think that the key message is to be aware that if you do borrow money from the company, then there is a tax charge which the company potentially has to pay if that money is still outstanding 9 months after the end of the year in which you borrow the money. I think the only other thing I would say is about directors' loan accounts and them becoming overdrawn, that, I mean, generally we would advise most clients, and I think most businesses and business owners would agree, that it's best practice not to have an overdrawn director's loan account. And it's something that generally you would want to try and avoid. And by that, we would normally set out a remuneration plan with clients where we will set up a salary level and a dividend level. And based on that, we can work out how much money the client and directors can draw from the business to draw down against those salaries and dividends that have been allocated to their director's loan account. So by careful planning, it's possible to make sure your loan account is always in credit. However, there are certain circumstances where it can actually be beneficial to have an overdrawn director's loan account, and there are some planning opportunities around that. So, like I say, generally we wouldn't encourage an overdrawn director's loan account, but sometimes there are planning opportunities that we can utilize the overdrawn director's loan account to the client's advantage as well. So that's everything we wanted to run through today. They were the three main topics that we wanted to discuss. I'm just conscious we're nearly out of time. So I don't know whether we've got any questions that have come through just before we wrap things up.
Yeah, I've got a couple of questions come through. Hopefully we can answer them fairly quickly. So someone's just been asking, what are the consequences of having a van instead of a company car? It's a really technical area in terms of vans. HMRC are very sensitive in terms of tax rates and in terms of VAT treatment of vans. There's various criteria, so it can be very beneficial, and it is generally cheaper to have a van. But let me know what van you're thinking of, because we just need to check, do they actually meet the standard requirement as what is called a van now? Because yeah, there's various rules to bear in mind, especially with VAT as well. There's lots of requirements. And then we've just had another one come in. So if taking the low salary and dividend route for pay, what is the best way to prepare for a major personal loan / mortgage? Lenders will ask for salary information, and dividends are variable numbers, not predictable. What we do there is we plan. So if you're telling us that I'm going to be buying a property in 3 years' time, we will say, okay, how much are you wanting to borrow? So you speak to your mortgage advisor, how much does the bank want to see as your remuneration there? So that's where we might actually give you a slightly higher salary. It all comes into a bit of lifetime planning here. So it's actually maybe we'll give you a higher salary, or we'll give you a lot higher dividends and we'll level them out. So that we'll say, yeah, don't take them all, but we're going to vote a whole heap of these dividends on you to boost that income, to show the bank your earning potential. So yeah, it's something to plan for, and generally they go back 3 years, your mortgage provider. So it's something to bear in mind sort of when you're gearing up to that, it's getting that planning in place.
Fantastic. Okay, well, brilliant. Well, that concludes our webinar today. So thank you very much for your time. Our contact details are on screen. So if you have any questions into anything we've discussed today, then please feel free to contact either myself or Shelley. And we hope you have a good rest of the day. Thanks very much.